For the better part of the last 2 months, stocks have roared higher. Now, it's in large part because we escaped from the shadow of a bad bond market. Remember, the bond market is much bigger than the stock market. And for months leading to the October bottom, long-term treasuries were just hideous, with prices plummeting and interest rates soaring. Now, all of that changed in late October when bond prices started rebounding, allowing long rates to come back down. And as I said at the top of the show, an environment where long rates are coming down creates a much better backdrop for your stocks. So can the bond rally continue, or is this move getting played out? That's a hugely important question for the stock market, which is why we got to figure this out. You know what we're doing? We're going to try to answer by going off the charts with the help of Carly Garner, a terrific technician who's the co-founder of DeCarly Trading and the author of Higher Probability Commodity Trading, and most important, someone who's been dead right. See, a little over a month ago, she told us to stick with the S&P 500, and she nailed it. And if you remember, back in September, she called the peak in oil. I mean, sweet crude call. What does Garner think of Treasury bonds right now? She acknowledges that they've gone from being a hot potato asset nobody wanted to hold to something that staged a historically sharp rally. And as she sees it, this rally is made possible by capitulation. As bond prices plummeted and rates soared in the fall, investors panicked and sold Treasuries like there was no tomorrow. Many money managers outright shorted them. That eventually created a coiled spring situation where everybody who wanted to sell had already sold, meaning Treasury prices only had one way to go: higher, no supply. And you know what? Money managers are still pretty darn bearish on Treasuries. I want you to take a look at this weekly chart of the 10-year Treasury note futures with the CFTC commitments of traders data down here. That's called the COT report. See, we love the COT report because it tells us exactly how home gamers, professional money managers, and commercial hedgers are positioned. The green line at the bottom represents the net position of large speculators, meaning the pros. Now, look at this. Garner points out that the large speculators got very, very bearish on the 10-year in the summer and fall. In fact, this was the biggest net short position we've seen since 2018, near the end of the Fed's late rate hike cycle. So you have to go back here. I'm sorry, you go back here, and this is where they were like, they overdid it, is what I want to say. They overdid their negativity, right? So what happened back then? From late 2018 through early 2020, these bearish money managers gradually flipped from short to long, causing the 10-year to rally 20 points, which is huge for fixed income, while the yield on the 10-year fell by more than 250 basis points. Garner's not necessarily saying we're going to repeat that same move, but she notes the money managers remain extremely bearish on the 10-year. See, they still have an extremely large net short position in the futures. And she wouldn't be surprised at all if the yield on the 10-year can fall 250 basis points from its high, simply because the short side of the trade got overcrowded. Why do we care? Okay, look, that stretch from late 2018 through the end of 2019 was fabulous for the stock market. So this could be, you might be able to say we're on the same trajectory. That is certainly good news. Now, when you zoom out and look at the monthly chart of the 10-year Treasury futures, Garner likes what she sees. Check out the relative strength index. That's at the bottom, okay? It's an important momentum indicator. It's now got upward momentum, but it's barely out of oversold territory. See, it's still all the way down here. In other words, even after the last couple of months, the 10-year is a long, long way from being overbought. It means it's not done going higher. Now, Garner thinks we're looking at a wholesale trend change, although she sees a ceiling of resistance. I know these are very clumsy looking, but let's bear with me here. She sees a ceiling of resistance at 111.15. Now, that would translate, this is what you need to know, to a 4% yield, okay? Thanks to that ceiling, she expects some near-term consolidation as the 10-year gradually works up another head of steam. Where can it go? In general, she sees the short sellers gradually unwinding their positions, which will steadily push the price of the 10-year higher. Remember, rates go down, bond goes higher. The next big resistance level kicks in at 117, okay? Now, what does that correlate to? A 3.25% yield. Wow, that would be something. Garner actually thinks it's possible the 10-year to get there without any additional action from the Fed. In other words, Fed don't have to cut. Just as the bond market did the heavy lifting when long rates soared earlier this year, it can do the same on the way down. And if the Fed starts cutting short rates anytime soon, Garner could see the 10-year going to 124. Yield roughly 2%. I've certainly seen this kind of move before. When the Fed beats inflation and stops tightening, we tend to get phenomenal bond rallies that push long-term interest rates lower. That is what I call nirvana for the stock market. Halcyon times. What about the other big picture issue? It's the strong dollar. Check out the weekly chart of the dollar index. Most industries like a weak dollar because it makes it easier for our businesses to compete with foreign companies. Unfortunately, when rates were soaring, that propped up the value of the dollar versus other currencies. With long rates now going lower, Garner says that will put downward pressure on the dollar. Yes, and that's something we're already seeing. With the economy getting back to more normal levels of inflation, she sees the dollar index headed still lower. The relative strength index here, it's got quite a ways to go before it gets oversold. If we do get that dip in the dollar, it is terrific for energy, material, metals, and all sorts of securities, including companies like Procter & Gamble. And that's a charitable trust holding with a gigantic exposure to currencies worldwide that has really been hurt by a strong dollar. Hey, now why don't we talk about oil specifically? Take a look at this chart of the seasonal pattern in the March crude oil futures going back 30 years. You can see that typically oil turns bullish in the second or third week of December. Sound familiar? Now, I know crude's being pulverized, including today, but take a look at the monthly chart of the West Texas Intermediate crude futures. Garner says that oil's mostly stayed within a given trading range since the bottom of 2015. See, look at this. Even though fracking, supply glut, it's still hanging out here. That's with the exception of some crazy action during COVID and the invasion of Ukraine. Unless we get another black swan type event, another one that's highly unlikely like Ukraine, she expects oil to hold above its floor of support, which is at 68, all right? Right, we are. For example, if today's beatdown, we might actually be looking at the lows. Well, it's possible oil can dip below that level before things turn around. But if crude holds above $68, pretty much where it is now, Garner's betting it'll head higher. With the next big ceiling resistance at around $100 a barrel, I mean, that would be straight up. That'd be not so great for the stock market. It would be certainly easier for oil to get there with Treasury yields and the dollar both getting weaker. Hey, by the way, Garner also noticed that the correlation between oil and natural gas has gotten much stronger over the last 30 days. They now trade in the same direction about 90% of the time. That's unusual. So if oil rebounds, natural gas should rebound too. While I'm with her on Treasury yields and the dollar, I'm certainly not rooting for higher energy prices. I'll take all the deflation we can get. Here's the bottom line. The charts interpreted by Carly Garner suggest that this more benign bond market could have a lot more staying power, which translates directly into a weaker dollar, both things that are great for the stock market. And she wouldn't even be surprised to see oil bottoming right here. Right here. Might seem hard to believe, but then again, who believed that long-term interest rates were about to peak 2 months ago? Wow, what a bunch of great calls by Carly Garner. I got to hand it to her. I want to speak to Zach in Pennsylvania. Zach.
Hey, Jim. Big booyah from Eagles Nation. How are you?
I am fine. A little beaten down from Sunday's action, but that's okay. We're 10-3. How can I help you?
Awesome. So I'm looking about 20-year horizon here, 20 years of homework and hold and all that. I'm a little worried about the 20-year projection on oil. My stock is Phillips 66.
Well, you know, 20-year projection, yeah, because you're probably thinking that we're going to be driving all EV cars and stuff, and I don't blame you for being worried. I don't take a 20-year projection for anything oil-related because of the possibility that EV takes over. That said, short-term, at least in the next year, I think that Phillips 66 is what I call an up stock because I happen to like the refining companies very much. Thank you for the nice question. All right, the charts as interpreted by Carly Garner suggest that both Treasury yields and the dollar have more room to the downside, which normally translates into more upside for your stock portfolio. Much more made money at. How should you prepare yourself for the IPOs of 2024? I'm setting you up with a preview of what to expect. Then, looking for opportunity in this tape, I've spotted an underappreciated corner of this market that I think investors could bank on in the coming months. And all your calls, of course, rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.